$3,000. That's what your Social Security statement says you're getting. $2,388. That's what actually lands in your bank account. If you're over 67 and still working, nobody warned you about that gap because everyone in this space is telling you your earnings limit doesn't apply to you anymore. They're right, it doesn't. But two other things do. I've spent 3 decades watching them cost people real money, and today I'm going to show you both. Stay with me to the end because underneath all this, there's a question that almost no one in this space will answer for you. Should you even be filing while you're still working? I'll give you my answer, and it's probably not the one you're expecting. First, let's clear the deck. If you've been anywhere near this topic online, you've seen the earnings limit 2026, $1 withheld for every 2 that you earn over that. But here's the thing. That rule stops the month you hit full retirement age. For most of you, that's 67. Congress ended it at full retirement age back in 2000, 26 years ago. There's a bill in front of the Senate now. It's the Senior Citizens Freedom to Work Act. It would kill the earnings limits for everybody. And it's getting all the headlines. And if it passes, it changes absolutely nothing for you because the version that you work under was repealed over a quarter century ago. So please, you're free to go ahead and earn every single dollar you want. Now let me show you what happens when you do. Your Social Security benefit gets taxed based on something called provisional income. And that's your adjusted gross income plus any tax-free interest plus half of your benefit. Cross $25,000 as a single filer, $32,000 as married, and part of your benefit becomes taxable. Cross $34,000 and $44,000, and up to $85,000 of it does. Let's look at those numbers again. $25,000, $32,000. Congress wrote them in 1983 and 1993 and has never indexed those for inflation. Not once. Heck, nearly every other number in the tax code moves every year. These two numbers are sitting exactly where they were when gas was $1 a gallon. Which means, if you have a paycheck, you're not near that line. You blew past that line somewhere in February. So here's the math on the real situation. $3,000 a month in benefits, $36,000 a year. 85% of it is taxable. And if you're in the 24% bracket, which is where most of the people I work with already land, that's $612 a month, $7,344 a year, gone on a benefit you already paid for across 40 years of payroll taxes. And 8 states will tack on another bite on top of that. If you want to see where this lands for your own numbers, there's a free assessment down in the description. About 28 questions, 10 minutes of your time, no statements, no personal information needed. My team reads it and sends it back to you what we see. The second one doesn't show up on your tax return. It shows up in your bank account. Medicare Part B in 2026 is $202.90 a month. That's the standard premium, and it comes straight out of your Social Security deposit before you ever see it. But cross $109,000 as a single, $218,000 as a married couple, and that premium jumps to $284, and it's called IRMAA. At the top, it runs $689. Now, here's the part that catches people. IRMAA is a cliff, not a ramp. $1 over that line, and you don't pay just a little bit more, you pay the whole tier. And timing is worse than the cliff. IRMAA looks back 2 years. Your 2026 premium is set by your 2024 tax return. So the premium that's shrinking your check this month was decided by a decision you made 2 Christmases ago. And by the time you felt it, that toothpaste, you weren't going to get it back into the tube. So let's sit on this for a second. The move you make this year sets your premium for 2028. That's not a Social Security question. It's not a Medicare question either. That's a planning question. And that lives in the crack between the person who manages your money and the person who files your taxes. And for most people, those two people have never spoken. This answer needs both of them. And they've never been in the same room together. That's the kind of thing the financial health score is built to surface, because it looks at the sequence, not just 1 year at a time. Now, I want to talk about you for just a minute, because I think most of the content out there gets you wrong. You see, the people that I see still working at 67 are not pressing out widgets on a shop floor. They're consultants, educators, teachers, attorneys, and accountants. They do knowledge work, and they're still doing it because they're good at it and they love what they do. Hey, I know a lot of people, some of them very close to me, who retired and found it just didn't sit well with them at all. They were good fathers, good husbands, good mothers, good wives, but they were also a teacher, a lawyer, or an accountant, and that's how they knew themselves. And when the work stopped, whether they chose it or someone else chose it for them, it was hard. Now, most of them found their way back to it. They cut hours, changed the shape, kept doing the thing. And you know what? I'm with them 110% on that. Because here's what almost nobody says out loud, though. After 30 or 40 years of something, most of these folks weren't working to cover the bills. The house was handled. The paycheck already covered their lifestyle, which sets up a whole new question. If your paycheck already covers your lifestyle, why are you taking a benefit you don't need right now? And paying tax on top of it in some of the highest income years you will ever have. The people I know who thought this through made a different call. They took Medicare, they passed on Social Security, and they kept working. Not because they didn't want the money. They had earned every dollar of it, and they knew they'd get it eventually. It's just that doing the work they loved was worth more than collecting on a schedule. And here's what that choice is actually worth, because this is the number nobody puts on a thumbnail. Every year that you wait past full retirement age, Social Security adds 8% to your benefit permanently. You wait from 67 to 70, and you're at 24% more every month for the rest of your life. Social Security's own 26 figures for maximum earners are $4,207 a month at 67, $5,181 at 70. And it compounds with something most people don't know, that the benefit isn't locked for your life. It's calculated on your top 35 earning years. So a good year at 68 can knock out a weak year from 1985 and raise your check permanently. And that's what your payroll taxes are buying you. Now, put those two clawbacks back on the table. The first one goes to zero. There is no Social Security benefit to tax because you didn't start one. The second one doesn't. And here's what a lot of content in this space gets wrong. Medicare and IRMAA don't disappear when you delay. If you enrolled in Part B and there's no Social Security check to pull from, CMS just bills you directly 4 times a year. And the surcharge rides right along on that bill. Nobody's handing out free Medicare for just waiting. But look at what that did do. It shut off the tax on a benefit you don't even need in the highest income years you'll ever have. It bought you 8% a year while you did it. One clawback has an off switch. The other has a dial. And almost nobody in this space will show you either one. Now, some of you may need that money. And that's a completely legitimate answer. And I'm not going to pretend otherwise. So if you're filing, the job changes. It becomes more of an income diet now, not earn less. Pull the right levers. Scale the work. Take on fewer clients. Fewer cases. Go 3 days a week instead of 5. This is the lever you completely control. And it's the one that almost nobody considers because it doesn't feel like a planning question. It is one. Defer into that plan. You can contribute to a 401k or a self-employed plan at any age so long as you're working. Every pre-tax dollar you defer comes out of provisional income and out of your IRMAA number. Same paycheck, slightly different footprint. Use a QCD starting at 70 and a half. That money goes straight from your IRA to a charity without ever hitting your tax return. And that keeps your income down right now. Later, required minimum distributions kick in. That same QCD can satisfy your mandatory withdrawal dollar for dollar. 2 different ages doing 2 different jobs. Know them both, and keep the still working rule in your back pocket for down the road. When you eventually hit 73, as long as you're not a 5% owner of a company or your plan allows it, required distribution on your current employer's 401k can be delayed until you actually do retire. That's income you won't be forced to recognize. Look at what all 4 of these have in common, because they pull the same lever, income. And that's the one lever that controls taxation of your benefits, your IRMAA tier, and your senior deduction, all at once. That's what I mean when I say this stuff is kind of like a liberal arts degree. 6 pieces kind of all touching. And if you're also helping a parent right now or still writing a tuition check, that same lever is doing double duty on those too. So, the answer to the question that I asked up top, if you're 67, love your work, and the paycheck covers your life, filing right now is often the worst move on the board. You take a benefit that's up to 85% taxable, and you give up 8% a year you'd have gotten for waiting. You paid for that benefit. Nobody's saying don't take it. I'm saying take it when it's worth the most. And until then, keep doing what you're good at and what you love. Hey, if any of this hits close to home, that's exactly what we do for our clients. We're taking on new clients that, hey, come by, say hello. Both of these key off one number, and that number is your income, which means the deductions you claim and the income you report are the same lever now. They're extra standard deduction rules for people 65 and older, and a state-level senior tax breaks on top of them that higher earners routinely phase themselves out of without even knowing. And they feed straight into everything we just covered. I broke that down in the next video. Go watch it. Hey, I'm Tim Gardner, and I'll see you in the next video.